This is your Essential Business Briefing. I'm Stephen Carroll. Coming up, the Covid-19 debt mountain. We count the trillions that have been borrowed during the pandemic. Is this extra debt a cause for concern? Who'll repay it? And should we rethink the way we look at government borrowing? Plus, how exactly do countries raise money on the markets? We'll take you inside the French government agency that can borrow billions in just a few minutes. Now, in a crisis that's caused economic shockwaves, governments around the world have spent trillions of dollars dealing with the pandemic. Some of that went on healthcare and much more on supporting workers and businesses through lockdowns and other restrictions. Today, we're looking at the Covid-19 debt mountain and what it means for us as taxpayers now and in the future. Let's start with a briefing from Kate Moody on the scale of this debt. Kate, what has happened to government borrowing in the past year?
Well, it increased by around 17% last year alone, over $12 trillion in new government borrowing. In the Eurozone, that pushed government debt to 98% of the bloc's GDP. That means the debt is almost equal to the value of everything the economy produces in a year. Greece has the highest rate of debt in Europe, over 200% of its GDP, while France topped 116%. Government debt in the US and UK also grew to be bigger than the size of their economies. Emerging markets took on more debt as well, climbing it to a relatively lower rate of around 60% of GDP.
Have companies and households taken on more debt as well?
Yes, but less so than governments have. Interest rates at the moment are so low that borrowing is easy. The Institute of International Finance says global household debt rose from around $48 trillion at the end of 2019 to over $51 trillion a year later. Corporate borrowing increased more by around $5 trillion. That brings the global debt load, including government, household, and company debt, to over $280 trillion. And analysts expect it to continue growing this year.
How does the debt situation now compare to previous crises like in 2008?
Well, debt increased higher and faster than in the past. As this graph from the IMF shows, public debt in both emerging and advanced economies is higher than at any time since the Second World War. Just over a decade ago, before the financial crisis, U.S. public debt was worth around 60% of GDP, and the EU actually had legislation mandating a similar cap, which it suspended during the pandemic last year. As debts continue to pile up, we could see a return to those sorts of controls.
OK, Kate Moody, thank you. Now, so the next big question is who's going to repay all this debt? Earlier this year, a group of more than 100 economists, including Nobel laureate Thomas Piketty, wrote an open letter calling on the European Central Bank to cancel the almost €2.5 trillion in public debt that it holds. ECB chief Christine Lagarde said that would be unthinkable and in violation of the EU treaties. Now, debt cancellation is just one part of the broader debate around debt. Let's speak now to Alexis Garati, who's head of macroeconomics at Euler Hermes. Alexis, thank you very much for being with us. I'm going to ask you first of all about that call from economists, including Thomas Piketty, for the ECB to cancel public debt. Is that a good idea, do you think?
No, I don't think so. I think that this is part of a very large debate at the global level, and I think this is an illusion to think that we can cancel the debt just because of the strong intervention of central banks. Fundamentally speaking, the stability of the debt depends on a relative manner, on the relative strength of the different economies. If at one stage the market understands that you won't be capable of repaying your debts, it will be highly destabilizing for your debt, the stability of your debt, and the stability of your economy.
So at the moment, then, do countries like France or the United States or maybe anywhere in Europe have to worry about how much debt they're piling up during this crisis?
I will say that nowadays, now in the current time, this is the sweet spot. I mean, everyone is engaged in issuing so much debt because of the intervention of central banks. Central banks, via their unconventional monetary policy, purchase huge amount of debt, which allow a large program of debt issuance, which allow to stabilize the economy in the context of the Covid-19 crisis. And I think that the most important aspect is the coordination, the fact that all developed markets and also emerging economies are engaged in the same manner in fighting the negative impact of the crisis with this debt policy. Means that today there is no discrimination by the market between the weak actors and the strong actors. So this is the sweet spot. But we have models in our side which show that even with this common aspect of debt issuance, sooner or later there is a day of reckoning for the most fragile economies.
So what do we need to worry about when that day of reckoning comes?
So what we need to look at is those advanced indicators, such as the widening of the spread, this difference between level of interest rate of a nation compared with a benchmark, for example, the US benchmark. And when those spread, this difference between national interest rate and the benchmark of the US starts increasing, it means that the market starts losing confidence in your capacity to repay debt. And at this stage, when spread starts widening, then it can be the beginning of a vicious circle. And then your currency could be potentially attacked by the market, obliging you to increase further the level of interest rate. And at one stage, the level of interest rate is so high in order to keep the stability of your currency or in order to attract potential investors in your debt that you penalize over extensively your economy, and you enter in a situation of crisis, in a situation of recession. So this is very bad for the economy.
Does that mean that countries will have to have austerity to remain credible in the eyes of the markets?
No, it doesn't mean obligatory or austerity. Let's take the example of the US, for example. For me, the credibility of the debt policy of the US relies on the credibility of its fiscal spending program. Biden's administration will reinforce in the future education, healthcare, infrastructure. All those elements will reinforce the potential of growth of the US economy in the future. We have calculated that instead of declining to 1.4% at the horizon of 2030, this potential of growth will be maintained in an area of 1.8 and 2% at the horizon of 2030, after the announcement of the new infrastructure program. So the design of your fiscal policy, the way you spend the debt that you have accumulated, makes the essential element of your credibility in terms of stabilization of debt in the future.
It's going to be people younger than you and I, taxpayers of the future, who'll be paying back a lot of this debt. Are they going to suffer as a result of this borrowing?
This is a very interesting question. Because if households and people like you and me anticipate the fact that we will pay a higher tax in the future, it can be an obstacle to a full recovery in a very short term. So it means that in the communication of the government, you need to find this balance between the stabilization of the debt and at the same time maintaining the level of confidence of households at a reasonable level. In this area, maybe there is more rebalancing to do between the level of tax which weighs on company versus the level of tax which weighs on household.
Does the fact that governments are going to have more debt and for longer mean that we have to change the way we look at this issue of how much debt governments have and perhaps the measurements we use for it?
Yes, I think that we need to think differently. This is fundamentally speaking, this is not a question of absolute level of debt, which is important. And for me, the way we need to change our reflection on public debt is the coordination aspect of this debt. So the most important is to initiate a coordination at a global level in order to be on the same line across developed markets and also with emerging economies on the way we will do to stabilize this huge amount of debt that we have accumulated. Common factor, or most of the time, more important than specific factor of every individual economy. So the coordination aspect for this stabilization of debt will be key in the future.
Okay, plenty to think about there. Alexis Garrity from Euler Hermes, thank you very much for speaking to us. Now, while countries have been borrowing record amounts on the markets, investors have been clamouring to buy their bonds. Here in France, these debt auctions are run by the government's Treasury Management Agency. So, how do they work? Catherine Viette explains.
On the top floor of France's finance ministry is the country's Treasury Agency. France's government debt is managed by this man. Every week, Anthony Roquin raises the money the French state needs to keep running. Today, he's going to borrow 6.2 billion euros. The debt auction will take just 20 minutes. These government traders are evaluating bids from 15 French and international banks. In less than 20 minutes, they have offers worth over 24 billion euros. That's 4 times the amount they're seeking. Investors are rushing to lend money to France.
People are sure that if they own this asset and wish to resell it, we will offer them a very good price.
With less than 10 minutes to decide, tensions are high. The slightest mistake could see France lose millions of euros. The selection criteria is very simple.
We will choose the best offer, the lowest rate for the best deal for the French taxpayer.
20 minutes later, it's done. France will borrow the money it needs at a negative interest rate of 0.6%. On the 6.2 billion euros being lent, the investor is set to lose 18 million euros. But France is considered a safe bet because it's guaranteed the money will be paid back.
Investors give us their money for a year, and we charge them rent for keeping it in our safe, which is the negative interest rate.
But when interest rates rise again, borrowing will get more expensive for the French government, which could cause problems down the line. France is expecting to borrow some 260 billion euros on the markets in 2021.
That's it from us for this week, but you'll find all of our previous episodes on our website and as a podcast wherever you usually listen. And if you'd like to get in touch with any comments or questions, you'll find me and the team on social media. Until next time, thanks for watching.